Welcome, curious minds, to another deep dive. Have you ever paused to wonder how some companies don't just survive, but truly thrive by operating in two vastly different, incredibly complex markets simultaneously?
That's a fascinating question, right?
Absolutely. Imagine a single company that crashed cutting-edge fighter jets for national defense and, in the very next breath, designs and builds luxurious private jets for the global elite. It sounds almost like a contradiction, doesn't it?
It really does on the surface.
But today we're taking a deep dive, a real shortcut to being well-informed into a fascinating company that does exactly that, Dassault Aviation SA. We've gathered a stack of investment research, company reports, and meticulous market analyses, and our mission is clear: to unpack what makes this French aerospace giant pick, understand its unique strategic position, and explore what its future holds. You're about to discover a company at a pivotal moment, balancing massive defense backlogs that stretch for years with a vibrant, high-end business aviation segment, all while navigating a challenging and rapidly evolving global landscape. This is where it truly gets interesting.
Indeed. And what emerges very quickly when you delve into Dassault Aviation is that it's far more than just a diversified company. It's a masterclass in integrated synergy.
Integrated synergy.
Exactly. Our analysis reveals a truly unique dual-segment business model that doesn't just spread risk, it actively provides remarkable counter-cyclical resilience. We're talking about a company that has not only secured an unprecedented defense order book, giving it nearly a decade of revenue visibility,
A decade.
but is also simultaneously renewing its highly profitable business jet line with exciting new models. Throughout this deep dive, we'll uncover its distinct competitive advantages, the significant operational hurdles it faces as it ramps up production, and what its robust financial position means for its long-term trajectory.
Okay.
We'll be focusing on 5 critical questions:
Right.
the sustainability of its competitive advantage, its future growth trajectory, how it allocates its substantial capital, the most significant risks on its horizon, and how the market currently values all these prospects. For you, the savvy learner, this isn't just a corporate profile. It's an insightful look into how a company can ingeniously leverage technological prowess and strategic positioning across diverse, demanding, and often contradictory sectors.
That's a powerful way to frame it. Integrated synergy. So let's unpack this core idea right off the bat. Dassault's dual expertise. You mentioned it's more than just two separate divisions. Our sources highlight it as a synergistic hedge. But for our listener, what does that actually mean in practice? How do these two seemingly opposite worlds, military combat and luxury travel, truly integrate?
It's a brilliant model, really, and the synergy is absolutely central to its success. In practice, it means the cutting-edge technologies developed for the Rafale fighter jet, things like advanced aerodynamics, sophisticated digital flight control systems that allow for incredible agility, and these ultralight composite materials for structural strength.
Fighter jet tech.
Exactly. These aren't just for military use. They're directly adapted, refined, and integrated into the Falcon business jet family. So when a CEO steps onto a Falcon, they're essentially flying on technology born from the demanding, high-stakes world of fighter jets.
Wow.
This cross-pollination of technology gives the Falcons a distinct, undeniable technological edge in the civilian market, truly setting them apart. This unique structure also creates what we call counter-cyclical resilience.
Okay, counter-cyclical resilience. Explain that a bit more.
Think of it like having two engines that run on different fuels, perhaps.
Yeah.
The long cycle, government-funded defense contracts provide an incredible bedrock of stability. These are massive, multi-year programs largely insulated from the ups and downs of broader economic cycles.
Right, government money is usually pretty steady.
Exactly. On the other hand, the business aviation segment, well, it's certainly more cyclical and sensitive to global economic health, but it offers the potential for much higher margins and faster growth during periods of economic expansion.
So one provides stability, the other provides upside potential.
Precisely. And what's particularly fascinating right now is that we're seeing a unique amplification of these benefits. Heightened geopolitical tensions are driving massive defense orders, and the business jet market, despite some, normalization, is still quite healthy.
So both engines are firing.
Both engines are firing, making this dual model incredibly advantageous in today's world. Yeah, quite remarkable.
So the Falcon is essentially getting trickle-down fighter jet technology. That's a powerful differentiator, especially when you're competing in the luxury market. Does this give them a unique edge against, say, a Gulfstream or a Bombardier that might not have that military tech lineage?
Oh, absolutely. It gives them a unique edge, yes.
And speaking of military tech, how has the defense segment, particularly the Rafale, really transformed Dassault's overall growth picture?
It absolutely gives them that edge. The military heritage translates into robust, reliable, and high-performance aircraft in the civil sector, which is a significant selling point for a discerning clientele. And regarding the Rafale, well, it's not an exaggeration to say it has transformed Dassault's defense segment into its primary growth engine.
It's a primary engine.
Yes, the Rafale isn't just any fighter. It's a French-designed, twin-engine, multi-role fighter, marketed with a truly unique descriptor, Omnirole.
Omnirole?
Omnirole. This signifies its extraordinary ability to perform a wide spectrum of missions, everything from air supremacy and interdiction to ground support, anti-ship strike, and even nuclear deterrence tasks that traditionally required multiple specialized aircraft. It's like having an entire squadron packed into one platform.
That's impressive versatility.
It is. And a key strategic differentiator, one that our sources repeatedly emphasize, is that the Rafale is almost entirely built by a consortium of French contractors. Dassault itself, Thales for its advanced avionics, and Safran for the M88 engines.
All French.
All French. This sovereign industrial base ensures France's strategic autonomy, which, crucially for export customers, means the platform is largely free from U.S. international traffic in arms regulations or ITAR restrictions.
Ah, the ITAR factor. That's huge for exports.
This is a massive selling point.
Yeah.
This freedom from external geopolitical influence is powerful for nations seeking to diversify their defense suppliers and maintain their own strategic independence. The Rafale platform is also designed for continuous evolution, a core tenet of its design.
Always upgrading.
Exactly. Current efforts are focused on the F4 standard, bringing enhanced networked combat capabilities, with delivery scheduled for 2027. Looking even further ahead, after 2030, the French government has initiated the F5 standard, designed to operate in conjunction with new unmanned combat air systems, or UCAS, leveraging technology from the Neuron demonstrator program.
Wow, drones operating with the fighters.
Yes, it demonstrates a long-term vision for maintaining the Rafale's relevance well into the future, ensuring it's not a static platform but an evolving ecosystem.
That continuous evolution from F4 to F5 and beyond with UCAS sounds incredibly ambitious and forward-thinking. It really positions the Rafale, and by extension Dassault, at the forefront of future air combat. Now, to ground this in numbers, what kind of financial impact has this focus on defense and the Rafale specifically had?
The financial impact has been nothing short of transformative. In 2024, defense net sales reached, $3,965 million.
So nearly 4 billion euros.
Nearly 4 billion, a substantial increase from 2,980 million in 2023, largely driven by 21 Rafale deliveries, 14 for France and 7 for export customers. But even more critical for long-term growth is the order intake, right. 8,309 million in 2024.
Over 8 billion in orders in 1 year.
Exactly. And get this. A remarkable 88% of that, or 7,294 million, came from export customers like Indonesia, which ordered 18 aircraft, and Serbia, which ordered 12.
So the export market is really driving this.
Massively. And this follows a truly record-breaking year in 2022, when defense order intake hit 17.5 billion, propelled by that landmark 80 aircraft order from the UAE.
17.5 billion. Incredible numbers.
Incredible. This surge in international orders represents what our sources call a fundamental and historic shift. It's transforming the Rafale from primarily a French military platform into a major global competitor, thereby significantly diversifying Dassault's revenue base away from its domestic market.
Right.
This fundamentally repositions them from a strong domestic player to a formidable international competitor, allowing them to truly compete on the global stage with the aerospace giants of the world.
That's a phenomenal shift. And speaking of global competitiveness, let's now transition from those high-stakes battlefields to the equally demanding but far more luxurious boardroom skies. Tell us about the Falcon brand. This is where Dassault targets the high-end private jet market, very clearly leveraging that dual expertise we just discussed.
Absolutely. The Falcon family of business jets competes in the mid-size to ultra-long-range, large cabin segments of the global market. They've earned a reputation for meticulously balancing superior performance like impressive speed and range with exceptional fuel efficiency, unparalleled cabin comfort, and a truly unique ability to access challenging airports.
Challenging airports, like shorter runways or high altitude.
Exactly. Imagine landing at a small high-altitude airport with a short runway where other jets simply can't go. That's a major selling point for discerning clients who value flexibility and direct access.
I can see that. So what's in the lineup now?
Well, the current Falcon portfolio is undergoing a significant renewal, which is a key growth driver. Their existing lineup includes the versatile Falcon 2000 LXS and the Trijet Falcon 8X, which offers an impressive range of 6,450 nautical miles. But the real excitement, the one that's generating significant buzz, is around the newer models.
Okay.
The Falcon 6X, which just entered service in November 2023, is celebrated for setting an entirely new benchmark in passenger experience. Imagine stepping into an aircraft and discovering it has the widest and tallest cabin in its entire class.
The widest and tallest.
Yes, it's almost like a penthouse in the sky, offering an unparalleled sense of space and comfort that significantly elevates the flying experience for the global elite.
A penthouse in the sky. I like that.
And then there's the future flagship, the most critical product for their civil segment, the Falcon 10X. This ultra-long-range jet, designed to fly an incredible 7,500 nautical miles, is scheduled to enter service by late 2027.
7,500 nautical miles. That's huge range.
It's huge. It's a direct, ambitious challenge to the top-tier offerings from competitors like Gulfstream and Bombardier, aiming squarely for the apex of the business jet industry in terms of range, luxury, and technology.
Aiming for the top spot. But how are these ambitious plans translating financially? And what are the operational insights for the Falcon segment specifically?
From a financial and operational perspective, it's a bit of a mixed but generally positive picture with a key challenge. In 2024, the Falcon segment generated net sales of $2,265 million on 31 deliveries.
Okay, over $2 billion.
Right. This was an increase from 2023, but notably fell short of the company's own initial guidance of 35 aircraft.
Missed the target. Why?
Management explicitly attributed this shortfall to persistent supply chain disruptions, a challenge that, as we'll discuss, is affecting the entire aerospace industry.
The supply chain strikes again.
It does. However, recent results from the first half of 2025 offer a more nuanced view. Falcon sales value actually increased by 12% year over year to $1.1 billion, even though deliveries remained flat at 12 units.
So higher price per plane.
Exactly. This indicates strong pricing power. They're able to command a higher value per aircraft, even with fewer deliveries, which speaks to the premium nature of their product. That said, new order intake in the same period did decline by 13% in value to $903 million.
Orders are slowing down a bit then.
Reflecting a broader market normalization from that extraordinary post-pandemic demand surge. So what this all means is that for Falcon, the primary constraint isn't a lack of demand. It's clearly operational execution and overcoming those nagging supply chain bottlenecks to get these high-value aircraft delivered to eager customers.
That makes a lot of sense. Demand is there, but execution is the hurdle. Now, before we zoom out to the broader market, we absolutely have to talk about a critical, often overlooked piece of Dassault's puzzle. Its strategic 25% ownership stake in Thales. It's more than just an investment, right?
Well, far more than just an investment. It's a crucial strategic asset. Thales, for those unfamiliar, is a global leader in aerospace, defense, and security electronics. They're a critically important strategic partner for Dassault, especially as a key supplier for the Rafale program.
Right, you mentioned their radar systems earlier.
Exactly. Thales provides essential components like the advanced RBE-2 AESA radar and other critical avionics systems that are integral to the Rafale's capabilities and competitive edge. This isn't just about supply chain efficiency. It's about deep technological alignment.
Okay, strategic alignment, but does it help the bottom line?
Materially. This holding materially contributes to Dassault's bottom line. For instance, the share in net income of equity associates line item in Dassault's income statement, which is largely driven by Thales' performance, added a substantial $460 million to pre-tax income in 2023.
Almost €500 million just from that stake.
Precisely. This clearly demonstrates how the stake provides both strategic alignment on key defense programs, ensuring tight integration of technology and supply, and a significant diversified stream of earnings, which importantly bolsters Dassault's overall financial profile.
Okay.
So you can see how this strategic holding goes beyond a simple stock investment, acting as a crucial component of Dassault's integrated business model and a source of consistent high-quality earnings.
That's a fantastic point about the Thales stake being a consistent earnings stream. Now let's zoom out a bit and put Dassault into its broader context. The aerospace and defense, or A&D landscape right now, is incredibly dynamic. We're talking about a period of robust, structurally supported growth that creates a huge tailwind for companies like Dassault. What exactly is driving this, and what does the overall market look like?
You're right. The overall E&D market is experiencing a significant uplift. Our sources tell us it's projected to expand significantly over the next decade, with forecasts indicating a compound annual growth rate, or CAGR, in the range of maybe 5.88% to 6.5%.
Healthy growth.
Very healthy,
Yeah.
potentially exceeding $1.25 trillion by 2034. This isn't just a temporary bump. This growth is driven by two powerful concurrent trends that are reshaping the industry.
Okay, what are they?
First, we have the strong post-pandemic recovery and a substantial modernization push for commercial aircraft fleets as airlines upgrade and expand to meet resurgent travel demand. Second, and perhaps even more significant for Dassault, there's a structural and sustained increase in global defense budgets.
Why the defense boost?
Geopolitical tensions, particularly the ongoing conflict in Ukraine and heightened strategic competition in the Indo-Pacific region, are compelling nations worldwide to modernize and enhance their military capabilities. Countries are realizing the critical importance of a robust defense infrastructure, leading to increased spending on everything from fighter jets to naval vessels. It's a clear, urgent response to a more volatile global environment.
Makes sense. But it's not all roses, is it?
No, not at all smooth sailing. A critical industry-wide challenge is that this surging demand is persistently outpacing supply. We're seeing widespread labor shortages and fragile, complex supply chains that are constraining production capacity across the board.
The supply chain issue again?
Exactly.
Yeah.
This is leading to record-high order backlogs throughout the industry that now stretch for years. And as we've already touched upon with the Falcon, this directly impacts Dassault's ability to deliver on its promises.
So we have this massive tailwind for the A&D sector, but also the bottleneck of supply chain issues. How does this demand-supply imbalance specifically play out in business aviation market where Falcon operates? Is it still in that extraordinary demand surge phase, or has it found a new equilibrium?
It's definitely transitioning, moving from that extraordinary demand surge that immediately followed the COVID-19 pandemic to a more stable, albeit still healthy, growth pattern.
Okay, so cooling off a bit.
A bit, yes. While flight activity, which is a good proxy for market health, remains elevated compared to pre-pandemic 2019 levels, market intelligence points to a clear normalization. For example, in the first half of 2025, we observed that the average time required to sell a pre-owned business jet increased by nearly 20%.
Takes longer to sell.
Right, suggesting buyers have more options and less urgency. Simultaneously, average asking prices for these jets declined 9% from their peak. So while the frenetic pace has cooled, it's crucial to understand that prices still remain significantly above pre-pandemic levels, indicating a fundamentally stronger market.
Still strong, just not crazy hot like before?
Precisely. The market is projected to grow at a healthy CGR of approximately 5% to 6.4% through 2032. Significantly, growth is expected to be particularly strong in the large cabin, long-range segment.
Which is exactly where the Falcon 10X plays.
Exactly. Which, as we discuss, is precisely the strategic focus for Dassault's new Falcon 10X. This highlights a very intentional alignment of their product strategy with where the market is headed. Geographically, North America continues to be the largest and most important market for business jets, making it a key region for Dassault's sales efforts.
Right.
This raises an important question, though. Given this shift, how well positioned is Dassault to capture this specific high-end growth, especially with the Falcon 10X on the horizon, without being overly exposed to general market cooling?
That's a great question, and it speaks to their focused strategy. Now, let's pivot back to the military side. In the high-stakes world of combat aircraft, the Rafale faces some truly formidable competition. We're talking about giants here. How does it stack up against rivals, and what's its distinct competitive edge in such a crowded and critical market?
In that intensely competitive arena, the Rafale definitely goes head-to-head with some titans. Our sources list American manufacturers like Lockheed Martin, with its dominant fifth-generation F-35 Lightning II,
F-35.
and Boeing, producing the highly capable F-15 Eagle and F/A-18 Super Hornet variants. On the European side, rivals include the Eurofighter Typhoon, built by a multinational consortium, and the Gripen from Sweden's Saab.
A tough crowd.
Very tough. Despite this formidable lineup, the Rafale has carved out a distinct and highly successful market position. Its primary competitive advantage isn't just its technological prowess, though it is an incredibly advanced, combat-proven omnirole fighter, capable of anything from air-to-air dogfights to precision ground strikes.
So what's the real edge, then?
The crucial geopolitical factor is that it's not subject to U.S. ITAR export controls.
Ah, back to ITAR.
Exactly. This means nations don't have to navigate potentially restrictive American foreign policy considerations to acquire and operate the aircraft. For countries seeking true strategic autonomy, looking to diversify their military hardware away from a single supplier, or simply those who may not be eligible to purchase top-tier U.S. equipment, the Rafale presents an incredibly compelling alternative.
A non-U.S. high-end option.
Precisely. Recent export successes perfectly illustrate this strategy. Significant orders from the UAE, India, Indonesia, Greece, and Croatia directly validate this differentiated approach. It's almost counterintuitive, but the F-35's global dominance has, in a way, created a lucrative niche for the Rafale as the preeminent non-U.S. high-end fighter.
Interesting. So the F-35's success actually helps the Rafale.
In a way, yes. It's the most capable 4.5 generation alternative for nations that either can't access the F-35 or prefer not to be locked into the U.S. defense and foreign policy ecosystem. It's a masterclass in strategic positioning, navigating geopolitics as much as technical specifications.
That geopolitical angle is truly a surprising fact that many might overlook. It highlights how much more complex these sales are than just raw capability. Now, shifting to the business jet market, how does Falcon carve out its niche against its North American rivals, given its smaller market share? Is it a similar story of strategic positioning?
If we broaden our view to the business jet landscape, Dassault certainly faces formidable North American rivals, but as you highlighted, it operates with a very different and deliberate strategy. Key competitors include Gulfstream, a subsidiary of General Dynamics renowned for its long-range jets, Bombardier of Canada with a wide range of offerings, and Cessna, a subsidiary of Textron Aviation known for its Citation family.
The big players.
The big players. In the crucial U.S. market, which often serves as a bellwether for the global industry, Dassault held a smaller but consistent 8.7% market share in 2023. This places it significantly behind the market leaders, Cessna with a dominant 35.3%, Gulfstream at 17.1%, and Bombardier with 12.5%.
Okay, definitely smaller share. So what's the strategy?
Well, this smaller share is explicitly described in our sources as a reflection of a deliberate corporate strategy. Dassault isn't chasing volume across all market segments. Instead, it precisely focuses on the technologically advanced, high-performance and high-margin niche of the market.
Quality over quantity.
Exactly. Its differentiators are those technological sophistications derived directly from its military programs. Things like industry-leading digital flight control systems, superior flight performance that allows access to more airports, exceptional fuel efficiency for lower operating costs, and a well-established reputation for quality, comfort, and reliability.
Leveraging that military tech again.
Consistently. The upcoming Falcon 10X is a clear manifestation of this strategy. It's designed to be a direct technological and luxury challenger to the flagship products of Gulfstream, such as the G700 and G800, and Bombardier's Global 7500 and 8000. So for you, the listener, understanding Dassault's strategy means that the success of the Falcon segment should be measured by its profitability and its ability to command premium pricing rather than simply by overall market share percentage. They're playing a different, higher-stakes game in a very specific, lucrative segment.
That distinction between market share and profitability is a key takeaway. Okay, let's dive into the fascinating world of Dassault's financials. When you first look at their income statement, one thing immediately stands out. Revenue can appear quite volatile. For example, our sources show adjusted net sales dipped from $6.9 billion in 2022 to $4.8 billion in 2023, then recovered strongly to $6.2 billion in 2024. Now, for the uninitiated, that might look concerning, but what's really going on here? Why this lumpiness, and what's a more telling metric for future growth?
You've hit on a crucial point that can be easily misunderstood. This lulliness in revenue isn't necessarily a sign of weakness in the underlying business. It's actually quite typical for defense contracting.
Right, these are huge, long projects.
Exactly. Imagine building a custom luxury yacht or a skyscraper. You don't recognize all the revenue the moment you sign the contract, or even month by month in a perfectly smooth curve. Instead, it's tied to major milestones, the completion of large work packages, and the actual delivery of incredibly complex high-value assets like fighter jets. These variable schedules of aircraft deliveries, often years apart, cause significant fluctuations in annual revenue recognition.
So it's just the nature of the beast.
It is.
Yeah.
So if you're looking for a more telling indicator of future growth and underlying business health, you absolutely should turn to the book-to-bill ratio.
Book-to-bill, all right?
This ratio compares the value of new orders received to the value of products or services shipped. In 2024, Dassault's book-to-bill ratio was a very strong 1.74x.
1.74. So orders are way higher than sales recognized.
Exactly. What that means is that new orders were 74% higher than recognized sales, continuously feeding that already record-breaking backlog we touched on earlier. It's a powerful forward-looking metric that paints a much clearer picture of the company's trajectory and future revenue potential, rather than focusing solely on the past year's recognized sales.
That's a great analogy, the skyscraper versus selling coffee. It really clarifies the lumpiness. Now, moving to profitability, there's a fascinating divergence between Dassault's operating and net margins. The adjusted operating margin has fluctuated within a fairly tight band, but the net margin expanded dramatically. What's the story here?
The story behind that divergence gives us a crucial insight into Dassault's true profitability and its strategic assets. The adjusted operating margin has indeed fluctuated between, let's see, 7.3% and 8.3% from 2020 to 2024.
Pretty stable operating margins.
Relatively stable, yes. These variations are influenced by a few factors, including the product mix higher margin Falcon jets versus potentially lower margin early-stage RAFEL production contracts, the level of self-funded research and development expensed in a given year, and broader inflationary pressures on the supply chain. This is the profitability of their core manufacturing business.
Okay, core operations.
Right. However, if you look at the adjusted net margin, it has expanded dramatically, reaching a substantial 17.0% in 2024.
17%, that's a big jump from the operating margin. What's driving that?
That significant boost to bottom-line profitability is largely due to the substantial contribution from the company's 25% ownership stake in Thales.
Ah, the Thales effect again.
Exactly. This flows through a specific line item in their income statement called Share in Net Income of Equity Associates.
Yeah.
So what this highlights for you, the learner, is that Dassault's reported profitability is significantly enhanced by its strategic equity holding in Thales, giving it a more diversified and robust earnings stream than just its core manufacturing operations alone. It's a hidden strength, a kind of anchor, that might not be immediately obvious if you only focus on the operating margins of their aircraft production.
That Thales contribution is definitely a powerful lever for their overall profitability. Now let's turn our attention to Dassault's balance sheet. Our sources describe it as a financial fortress. When I hear that, I picture something incredibly robust and conservative. Can you paint a picture of just how strong their financial position is and what this massive cash reserve truly means for the company's strategic flexibility?
Financial fortress is absolutely the right image. This company operates with remarkable conservatism and strength. Our sources highlight that Dassault has minimal debt, a mere $240 million at year-end 2024.
Tiny amount of debt for a company this size.
Tiny.
Tiny.
Against a total equity of $6.33 billion, this results in a negligible total debt-to-equity ratio of about 4%, which is practically unheard of for a company of this scale and in such a capital-intensive industry. They could basically pay it off with pocket change.
Incredible. And the cash.
Even more impressive is what our sources call their massive cash reserve. Dassault reported €8.4 billion in available cash at year-end 2024, a significant increase from €7.3 billion in 2023.
8.4 billion euros in cash.
Sitting there. So what does this all mean for you, the observer? This unparalleled financial flexibility allows the company to do several critical things. It can fund extensive multi-year R&D programs like the FCAS without needing to borrow heavily. It can finance major capital expenditures needed for production ramp-ups, like getting more Rafales and Falcons out the door.
Funding growth internally.
Exactly. And critically, it can comfortably navigate any potential economic downturns or unexpected challenges without financial strain. Imagine weathering a deep recession or a major supply chain shock. This cash acts as an enormous safety net, giving them the resources to invest in their future and ride out any storms without relying on external financing. It's an enviable position of independence.
That level of financial independence is truly rare, especially in an industry requiring such massive capital outlays. Now, let's look at how that money actually moves through the company. Their cash flow profile shows some significant swings from negative to hugely positive. What's driving this volatility, and what structural advantage does it reveal about the defense industry?
If we connect this to the bigger picture of how the defense industry works, particularly for large, long-cycle projects, Dassault's cash flow profile reveals a significant structural advantage. Our sources show that cash from operating activities exhibits significant swings, moving from a negative $670 million in 2023 to a positive $1.88 billion in 2024.
Big swing.
Huge swing after an even more massive $5.11 billion inflow in 2022.
Wow, $5 billion in cash flow in 1 year.
Yes, this volatility is a hallmark of the industry and is directly tied to the timing of large advance payments received from customers for major aircraft orders.
Ah, the down payments on those big orders.
Exactly. For instance, those record Rafale orders from the UAE and other nations in 2022 led to that surge in operating cash flow as substantial down payments were received up front. It's like a customer putting a huge deposit down on that luxury yacht we talked about earlier, years before it's delivered.
Got it.
This dynamic is reflected in the large and growing customer advances or contract liabilities on the balance sheet. Essentially, customers are effectively pre-funding the multi-year production cycle of their aircraft.
Customers are funding their working capital.
Pretty much. This is a tremendous strategic advantage for Dassault, as it drastically reduces the company's need for external financing to fund its working capital and inventory buildup, thereby significantly lowering its overall cost of capital. These advances aren't profit themselves, but rather a substantial, interest-free float provided by customers that underscores the financial strength and credibility of their order book.
That's fascinating.
It is. And this raises an important question. How does this customer-funded model specifically de-risk the company's ambitious production ramp-up plans for the Rafale and Falcon lines, alleviating some of the financial burden for Dassault?
That's a fascinating structural advantage, essentially, getting customers to finance your operations. Finally, on the financial front, let's look at how efficiently Dassault is generating profits for its shareholders, specifically through the return on equity, or ROE, metric. It's been improving, but our sources note it's somewhat suppressed by the large and growing equity base and those cash reserves. What does that imply for the company and its potential?
Indeed, ROE is a critical metric for shareholders, and our sources indicate that Dassault has steadily improved from 6.6% in 2020 to a solid 14.6% in 2024.
Good upward trend.
A positive trend, yes, demonstrating improving underlying profitability. However, you hit on the subtle but important nuance. Our sources also note that this metric is somewhat suppressed by the large and growing equity base, which is itself inflated by the substantial cash reserves on the balance sheet.
So the massive cash pile actually makes the ROE look lower than it might otherwise.
Exactly. So what does this all mean for you, the investor or observer? It suggests that while Dassault is undeniably profitable, if this massive cash reserve isn't deployed efficiently into value-creating projects, it can actually act as a drag on ROE. It's like having an enormous savings account. It's great for security, but if that money isn't earning a high enough return, it can make your overall investment portfolio look less efficient.
Right.
In other words, it implies there's potential for even higher returns if that capital were to be put to work more aggressively, perhaps through new R&D investments, strategic acquisitions that bolster their capabilities, or even more substantial shareholder returns like buybacks or dividends. It's a fascinating dynamic of having an embarrassment of riches, in a way, where the sheer size of their cash hoard, while a strength, can optically dilute some performance metrics.
That's a classic good problem to have too much cash. But it definitely adds another layer to understanding their financial picture. Now let's shift gears and look ahead. What's fueling Dassault's future growth? And it seems like their unprecedented order backlog is the most obvious answer here.
Absolutely. The backlog isn't just an answer, it's the answer. It is truly the biggest growth driver and forms the indisputable foundation of their future. As of December 31st, 2024, the total consolidated backlog reached a new record of 43.2 billion.
43 billion euros.
Billion with a B. That's a substantial increase from 38.5 billion at the end of 2023 and 35.0 billion in 2022. To put that into perspective, this includes 220 Rafale fighter jets.
220 Rafales waiting to be built.
With an incredible 164 of those destined for export customers and 79 Falcon business jets. This massive increase highlights the company's incredible success in converting the increased geopolitical demand we discussed earlier into firm long-term contracts.
So why does this matter so much?
Why it matters to you is simple. This backlog provides exceptional visibility and de-risks the company's financial outlook for the better part of a decade.
A decade of visibility. That's huge.
It's essentially guaranteed revenue for years to come, providing a stable foundation that very few companies in any industry can boast. For a management team, this offers incredible planning security, allowing them to make long-term investment decisions. Diving into the data for 2024 specifically, Dassault secured 30 new Rafale orders and 26 Falcon orders, while delivering 21 Rafales and 31 Falcons.
Still delivering, but the backlog keeps growing.
Exactly. The year-end Rafale backlog surged from 164 units in 2022 to 220 in 2024, clearly demonstrating that despite deliveries, new orders are consistently outstripping production, fueling that ever-growing backlog even further. It's a fantastic problem to have, converting geopolitical tension into long-term financial security.
That's a powerful point, converting geopolitical trends into tangible long-term contracts. And speaking of geopolitics, what's fascinating here is how Dassault is capitalizing on this favorable global environment, not just to sell more aircraft, but to strategically expand its global defense footprint through deeper industrial partnerships, like the Make in India program. How is this strategy playing out?
It's a brilliant strategic move, really. Moving beyond simple transactional sales to create deeper, more enduring relationships. The Rafale has achieved a series of major export victories, securing orders from new customers including Indonesia, Serbia, Greece, and Croatia, in addition to that landmark 80-aircraft deal with the United Arab Emirates.
Building a solid customer base?
Absolutely. And in the first half of 2025, a crucial contract for 26 Rafale Marine fighters for the Indian Navy further solidified its already strong strategic relationship with India. Management has even indicated ongoing negotiations for 2025, suggesting that this order momentum could very well continue.
More orders potentially coming.
Potentially. A key element of this international strategy, and one that moves beyond simple transactional sales, is the Make in India program. This involves deep collaboration with Indian partners like Tata Advanced Systems for local manufacturing of components.
Building parts in India.
Yes. This approach, which moves beyond simple transactional sales to co-production and technology transfer, is increasingly becoming a prerequisite for securing follow-on orders from the Indian government, and serves as a model for how Dassault is building strategic partnerships in other key markets. It's about creating long-term relationships, sharing industrial capabilities, and fostering mutual dependency.
Makes sense politically and strategically.
It does. And this raises an important question. How does this strategy of industrial partnership, integrating local manufacturing and technology transfer, contribute to the long-term sustainability of Dassault's competitive advantage on a global scale, especially in complex, politically sensitive defense markets where sovereign control is paramount?
That's a critical question for their long-term position. Beyond these existing and developing partnerships, what are they doing to secure their future for decades to come? I'm talking about the next-generation platforms like the Falcon 10X, and even more ambitiously, the Future Combat Air System, or FCAS.
You're absolutely right to look to these next-gen platforms because they are the anchors of Dassault's long-term relevance. The company isn't resting on its laurels. It's making significant, almost visionary investments.
Okay, tell us about the Falcon 10X first.
For the civil segment, the Falcon 10X is undoubtedly the most important growth catalyst. Designed to be an ultra-long-range jet with an impressive 7,500 nautical mile capability, and what the company proudly touts as the largest and most comfortable cabin in the market, it's on track for service by late 2027. This isn't just an incremental improvement. This aircraft is positioned to compete at the apex of the business jet industry, directly challenging the most luxurious and technologically advanced offerings from its rivals, setting a new standard for luxury air travel.
Taking on the best of the best. And on the military side, FCAS.
Yes, the Future Combat Air System. Dassault holds the critical role of industrial leader for the New Generation Fighter, or NGF, which is the centerpiece of FCAS. This incredibly ambitious trilateral program involving Germany and Spain alongside France aims to develop Europe's next-generation air combat system for the post-2040 era.
Post-2040, that's really long-term planning.
Monumental undertaking, designing not just a jet, but a system of systems, including drones and advanced sensors, that will define European air power for decades. So what this all means for you is that Dassault's leadership in FCAS not only secures its role at the heart of European defense aerospace for decades to come, but also ensures a continuous pipeline of cutting-edge technological development that will benefit the entire company.
Feeding back into both sides of the business.
Feeding back into both its military and civil segments. It's a long-term play, but one with massive strategic implications for their future.
So these are massive capital-intensive projects, which brings us to the foundation supporting all this future innovation, their consistent investment in research and development. How significant is this R&D commitment, and why is it so crucial for Dassault's strategy?
If we connect all these ambitious future programs to their core enabler, It all comes back to consistent and substantial investment in research and development. Our sources highlight that in 2024, self-funded R&D expenditures amounted to $437 million,
Nearly $500 million on R&D.
representing a significant 7.0% of total sales. In an industry where technological superiority is paramount, this isn't just spending, it's the lifeblood of the company's future competitiveness.
Gotta stay ahead of the curve.
Absolutely. This commitment to innovation is fundamental to maintaining the company's technological edge across both its defense and civil segments. It's a clear signal of management's long-term vision and their dedication to remaining at the forefront of aerospace technology. For you, the listener, this isn't just a line item on a financial statement. It's a strategic investment in future competitiveness, ensuring that Dassault can continue to offer cutting-edge products that not only maintain their high-value market niches, but actively expand them. It's how they stay ahead in an incredibly demanding and technologically intensive industry, keeping that dual-engine model flying at a maximum efficiency.
That consistent R&D is clearly a non-negotiable for a company like Dassault. But even with all these strengths and growth drivers, every company faces risks. Our sources highlight a critical shift in the nature of the primary risk for Dassault. It's no longer just about securing orders, is it?
You've perfectly captured the evolving risk landscape for Dassault. The nature of the primary risk has indeed notably shifted. In the past, the main concern might have been securing enough orders to keep production lines busy. But now, with that record backlog, the most significant and immediate risk is operational.
Getting the planes built and delivered?
Exactly. Managing an unprecedented production ramp-up for the Rafale program? The goal is to reach a target rate of 3 aircraft per month, which is a monumental increase in output for such a complex product.
3 Rafales a month? That sounds intense.
It is. And they have to do this while simultaneously producing Falcon jets and introducing entirely new models, the 6X and the forthcoming 10X, the core challenge. This must all happen within a fragile and constrained global aerospace and defense supply chain, which is still facing persistent shortages of raw materials, critical components, and skilled labor.
That supply chain bottleneck again. It seems to be everywhere.
It's a delicate ballet of parts and people, where a single missing component can halt an entire assembly line. CEO Eric Trappier has repeatedly and publicly highlighted supply chain shortcomings as a major challenge, and we've already seen its impact on Falcon delivery targets, where they fell short of guidance.
So the risk is real. What are the consequences if they can't ramp up?
Failure to meet these ambitious production and delivery targets could lead to significant delivery delays, costly overruns, contractual penalties, and ultimately damage to the company's reputation for reliability, which is an invaluable asset in an industry built on long-term trust and consistent performance. It's truly a high-stakes balancing act.
That's a stark reminder that even with huge demand, execution is everything. But beyond the factory floor, what about the broader economic and geopolitical risk that could impact Dassault, especially given its dual segments? And how does that fortress balance sheet you mentioned earlier help mitigate these?
If we broaden our view beyond the operational challenges, Dassault indeed faces risks spanning both economic and geopolitical domains. On the economic front, the Falcon business jet segment is inherently cyclical and highly sensitive to the health of the global economy.
Biz jets follow the economy.
Closely. Demand for business jets is closely correlated with factors like corporate profitability, global GDP, and overall business confidence. A sharp or prolonged economic downturn could almost certainly lead to a reduction in new orders, deferrals, or even cancellations, negatively impacting the revenue and profitability of the civil aviation segment.
Okay, so economic downturns are a risk for Falcon. What about defense?
Then there are the geopolitical risks. While the defense business is less cyclical, it is entirely dependent on the budgetary priorities and political decisions of sovereign governments. Shifts in government policy, defense budget cuts, or the cancellation of a major program could have a material impact. Furthermore, all export sales are subject to stringent French export control regulations.
Right, politics can stop a sale.
Absolutely. Changes in these regulations or evolving geopolitical alignments could prohibit sales to certain countries. Dassault has even directly experienced the impact of international sanctions, having had to deal with cancellations and support issues related to Russian customers following the invasion of Ukraine.
So real-world impact there. Any other big risks?
Finally, there's technological and competitive risk. The industry is characterized by intense competition from large, well-funded global players, and the long, costly development cycles of new aircraft mean that a technological misstep or a competitor's successful launch of a superior product could have long-lasting consequences for market share. The industry's transition to sustainable aviation also presents both opportunity and risk, requiring substantial investment in new propulsion systems and fuels.
A lot to navigate. So how does the balance sheet help?
Now, to address your question about the fortress balance sheet, this is precisely where it becomes an incredibly powerful buffer. That $8.4 billion in available cash and minimal debt give Dassault the financial muscle to absorb economic shocks, self-fund critical R&D if government funding falters, and even weather potential contractual penalties or delays without jeopardizing its long-term viability. It acts as a massive shock absorber, allowing them to navigate these diverse and complex risks from a position of profound financial strength.
That's a comprehensive overview of the risks, and it highlights just how crucial that financial strength is. Now let's talk about the people steering this ship. How would you characterize the quality of Dassault's management, and what are the implications of its rather concentrated ownership structure, especially for minority shareholders?
On the management front, the team, led by Chairman and CEO Eric Trappier, has an impressive track record of navigating incredibly complex international negotiations to secure those landmark export contracts that have fueled their massive backlog. Their strategic vision is incredibly clear and consistent: maintain technological sovereignty and leadership through their dual expertise model.
Strong leadership, clear vision.
Yeah.
But what's the challenge now?
However, as we just discussed, their most significant operational challenge in a generation is now translating that massive backlog into a successful and profitable production ramp-up. The ability to execute on this will be the key measure of management's performance over the next 5 years, more so than any new sales.
Execution is key. Now the ownership.
Now, let's consider the shareholding structure, which is definitely distinct. Dassault Aviation is defined by its concentrated ownership structure. The founding Dassault family, through Group Industrial Marcel Dassault, holds significant control. As of a recent disclosure, they controlled 62.2% of shares and an even higher 76.9% of voting rights.
77% of voting rights.
Thanks to French laws granting double voting rights for long-term shareholders. Airbus is also a significant long-term shareholder, holding about 9.9%.
So the family is firmly in control. What does that mean?
So what does this all mean for you, particularly if you're a minority shareholder? This concentrated structure provides long-term strategic stability and insulation from short-term market pressures, allowing management to make multi-decade investments like the FCA's program without being swayed by quarterly results or activist investors.
Stability is good. What's the downside?
However, the trade-off is significant. For minority shareholders, it significantly limits their ability to influence corporate strategy, board composition, or major capital allocation decisions. You're essentially investing alongside a very powerful founding family, trusting their long-term vision, but with very little individual say. It's a balance between stability and a lack of direct influence.
That's a crucial distinction for potential investors to understand. Finally, let's consider how the market values Dassault Aviation, particularly given all these unique dynamics, the dual segments, the massive backlog, the fortress balance sheet, and that concentrated ownership. Is the market truly capturing its full value?
That's the million-euro question, isn't it? When compared to European A&D peers, Dassault's PE ratio of 27.4x is lower than some specialized defense companies like Saab at 52.2x or Rheinmetall at 87.9x, which have seen their multiples expand dramatically due to direct exposure to the Ukraine conflict.
So lower PE than pure defense plays. How about diversified peers?
It trades at a similar PE multiple to more diversified peers like Safran at 28.3x and Leonardo at 26.3x. A valuation discount could certainly stem from its exposure to the cyclical business jet market, as that tends to introduce more uncertainty.
Okay, the biz jet exposure might hold it back. Any arguments for a higher valuation?
Conversely, a premium could be justified by its superior balance sheet, the high revenue visibility from that massive backlog, and its leadership role in strategic future programs like FCAS. Our sources argue that the unprecedented backlog arguably warrants a higher multiple, historically, given how much it de-risks future earnings streams.
So the backlog visibility is a major plus. Is there another way to look at the valuation?
This leads us to the concept of intrinsic value, particularly using a sum of the parts or SOTP framework.
Sum of the parts, breaking it down.
Exactly. A standard consolidated multiple like PE might fail to capture the full value of Dassault's distinct assets. An SOTP analysis would involve valuing the defense segment, the Falcon segment, and crucially, adding the 25% Thales stake at its current market price, and then adding that substantial net cash position directly.
Valuing each piece separately plus the cash, and what does that suggest?
This approach would likely highlight that the current market capitalization does not fully reflect the combined value of its distinct assets. This suggests there might be embedded value that is not immediately apparent to the market when looking at a single blended valuation multiple.
Potential hidden value? What about dividends?
The dividend yield at 1.7% offers a modest but exceptionally secure return, given their cash reserves and earnings outlook.
So pulling it all together on valuation.
In summary, the current valuation appears to be balancing compelling fundamentals with significant operational risks, incorporating a discount for execution risk, Falcon cyclicality, and the concentrated ownership structure. The market sees the opportunity, but is also keenly aware of the hurdles.
Wow, what a deep dive into Dassault Aviation. We've truly seen a company that's a dual expertise powerhouse, from its Rafale fighter jets defining strategic autonomy for nations worldwide, to its Falcon business jets pushing the boundaries of luxury aviation for the global elite.
Quite the combination.
We've uncovered how its massive defense backlog provides a decade of revenue visibility, how its fortress balance sheet offers incredible flexibility and resilience in uncertain times, and how its strategic investments in programs like the Falcon 10X and the Future Combat Air System are securing its role at the forefront of aerospace for decades to come.
Absolutely key points.
But we also look squarely at the challenges. The crucial shift from demand risk to execution risk, particularly the monumental task of the Rafale production ramp-up in a fragile global supply chain. It's a company with immense strengths, but one now profoundly defined by its ability to deliver on its promises.
This deep dive truly illustrates how sustainable competitive advantages can be built through both sovereign technological prowess and astute strategic market positioning, like the Rafale's unique niche as a high-end, ITAR-free fighter.
That ITAR-free point is so critical.
It really is. We've highlighted how management's disciplined capital allocation prioritizes long-term growth and technological leadership, even over aggressive short-term shareholder returns, which, as you know, is a rare sight in today's market.
Very patient capital.
Extremely. The most significant takeaway for you, the learner, is the paramount importance of operational execution in unlocking value, especially for a company with such a robust order book. The market clearly sees the value, but is also factoring in the inherent difficulty and complexity of turning those orders into delivered revenue-generating aircraft.
Execution, execution, execution.
Exactly. This raises an important question for you to consider. As global tensions continue to evolve and the aerospace supply chain remains under pressure, how will companies like Dassault adapt their dual-segment strategies to remain agile and resilient? Will the long-term stability and counter-cyclical nature of defense contracts always outweigh the cyclicality and premium opportunities of business aviation? Or could new geopolitical shifts eventually reverse that balance, forcing a reevaluation of which segment truly drives their strategic future?
A fascinating question to ponder.
It's a dynamic equation worth pondering and a testament to the complexities of global aerospace.